All right, good morning, everybody. Wow, what a big couple of days in the mortgage markets. We are going to cover not only what's been happening this fall, but what we can see happening for the 2024 housing market, the stuff that's in the data already, and what might change in a dramatically different mortgage environment. Holy moly, what a couple of big days. Um, we'll get diving into the data in a second. As always, as people are logging in, we will record the webinar. So anybody who's an attendee will get an email later on, and you'll be able to watch the video and share it. Um, we will be using the chat. So Lael and Jessica from the Altos team are in the chat as I'm talking about the data during the day. And if I share links or things to go click on, use the chat. You can go click through there um, and uh, and go um, follow through and download stuff, that kind of thing. Use the chat. So um, let's get started. I am Mike Simonsen. Welcome to the December Altos Research webinar. It's been a crazy fall, and suddenly things look like they might be changing dramatically again for the spring. At Altos, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. And when you're communicating with buyers and sellers, people need to understand what's happening right now in the housing market. And they're all reading the headlines, and the headlines are all over the place. And they can, in the same day, read headlines that say the market is crashing and the market is on fire. And consumers need to hear the data directly from you. So we're going to talk about the data, and we're going to help you learn to communicate about the data as well. We have a ton of people on from all over the country today. Feel free to use the chat, drop your questions in there. Lael and Jessica from the Altos team are in the chat to be able to answer things on the fly and share links and stuff. So use that. And with that, we will get started. The agenda for today, we're talking about prices. We're talking about inventory levels, sales volume, all the data that we can see for 2024 already, what it's looked like for 2023, and our best view for the coming year. We're going to talk about mortgage rates and the impact of mortgage rates because it's been a nuts few days. Holy moly. Mortgage rates are down again today. And what does that mean for home buyers in particular, buyers and sellers, but buyers in particular in the new year? Will we have a flood of sellers who've been sitting on the sidelines who are now finally unlocked and can sell? Will we have buyer competition? What's it going to look like? As always, we'll spend time with the local markets. Some are behaving very differently, and I'll try to show you those during at the second half of the webinar. I can't obviously get to all local markets during the conversation. So if I don't get to your local market, uh, the best thing to do is to book time with the Altos team, and we will review your local markets and how you can use the data with your clients today, starting today. So if I don't get to your local markets, just book time with our team. And as we're going through, I will try to use the frame about how to communicate with buyers and sellers right now, what they're saying, what they're seeing, and how we need to communicate what is actually happening in the market. So before I dive into the data, if you haven't already downloaded our free ebook, How to Use the Market Data in Your Business, I recommend you do so right now. There are scripts and ideas and strategies. Helps if you're not super familiar with the data yet, like get that ebook. You can learn how to talk about it and when to share data and what are some ideas that people need to hear. And it talks about the same data that I'm using in this webinar today, so you can go build your own conversation around that. Okay, so that's the ebook. Let's dive into some data. So let's start with inventory. There are 546,000 single-family homes available unsold on the market as of this week. we can see that multiple years of inventory trends in this chart here, back into 2015, almost a decade ago. And you can see generally how inventory fell over that time. And in the last couple of years, as rates were rising, the inventory has risen also. So inventory rose well into November this year. It's very unusual. Most of the time by November, inventory is almost all the way down to its low point already. So at least halfway down, it's each of those annual cycles. And we are just now around the corner. So inventory has been setting up to start the year with more inventory. We're a couple percent higher than we were last year at this time. Finally starting to see maybe some sellers eke their way back into the market. At 546,000, it's still like less than 40% of what we had in recent years. At this time of year, like even in 2015, November, is over 1 million homes on the market right now. So half of that is available inventory. So when we're thinking about when buyers and sellers are thinking about how to strategize for 2024, we are still in a very restricted inventory environment. That is true in almost all markets around the country. There are a couple that I will share, showing where inventory is up and inventory is higher than it was pre-pandemic, like 2019 time. But most of the country is still very low. So now what we want to think about is what happens to inventory when mortgage rates fall or rise. So we look at this over time, and we can overlay the mortgage rates. So the green parts here are the periods when mortgage rates were falling. Earlier in the decade, mortgage rates were low and generally falling each year, 15, 16, 17, 18. And when rates fall, inventory falls. That's because we buy more properties, we hold more, it's cheaper to hold them, so we sell it less often, and therefore the available inventory tightens up. In 2018 to 2019, rates rose by 100 basis points. And you can see that little pink section in the middle there, the inventory started 2019 with more inventory than 2018. 2020, rates fell dramatically and inventory fell dramatically. Then last year, rates spiked dramatically, inventory shot up dramatically, real steep last year. This year we had a little down cycle. We had surprisingly amount of buyers earlier in the year. Then starting at about April, May, mortgage rates climbed all year to the highest in multi-decades, and inventory climbed into late November. Mortgage rates are down the last couple of weeks, and if rates stay down or tick lower into January, that's going to have a dramatic impact on buyers in the new year. And here's the way I look at it. So the rule of thumb is that when rates climb, available inventory, unsold homes, a selection for buyers climbs. When rates climb, inventory climbs. When rates fall, inventory falls. So because we had rising rates the second half of the year to the multi-decade highs, we are starting the year with more inventory, a couple percent more than when we started last year. But now we're shifting. Rates are down. If they stay down and continue to tick lower, that inventory is going to get eaten up. So buyers are going to see more affordable prices, there are more affordable payments, but they are going to see more buyer competition and less selection in the new year. It's a really fascinating dilemma, right? How do they act? Well, they have to think about their affordability and is the property the one they like? They're going to face those decisions. But the rule of thumb that they should know is that if rates fall and if rates continue to fall next year, they're going to experience a tighter market with less selection. If, on the other hand, rates go back up, because I don't predict mortgage rates, they could go up from here, they could go down. I have no idea. I never saw 8% coming. So I think it's fair to say that if rates go up from here, we'll see inventory build. You'll see fewer buyers. You'll see more sellers who properties it doesn't pencil out. So those come back on the market. So when holding costs are higher, we hold less and inventory builds. Um, as it looks right now, we're going to start the year with a couple percent more inventory, but it could drop dramatically very quickly in the first quarter if rates stay where they are and like continue this trend of the last couple of days. Really dramatic, huge drops in mortgage rates, really affordability changes, big deal. So that first rule of thumb for clients to think: if rates climb, inventory will climb. If rates fall, available inventory will fall. Um, so why have we been so restricted on inventory this year? When we look at new listings each week, the lines here, the gray ones are past years, and the dark red line is this year. Most of the year, we had dramatically fewer sellers any given week than we had in recent years. And just in the last few weeks, we have had slightly more sellers than last year. We're not at a lot yet. The red line is still below all that cluster of gray ones, but slightly more sellers. And what happens is, so, I mentioned rates climb, inventory climbs, rates fall, inventory falls. If rates stay the same, that's actually slightly bullish. That means slightly more sales happen. And the second rule of thumb on mortgage rates is consumers are more sensitive to changes in rates than to the absolute levels. So even if rates stay around 7% this year and they bounce around 7% all year, if we're in that case, we will see more sellers, we'll see more transactions, even though 7% is significantly less affordable than it was 18 months ago. We will see more of those happening. On the other hand, we're now at 6.8 or 6.6 or something today, after 2 big days of drops. If suddenly we go back to 8, that shift, that climb is a big move. And so consumers are going to be sensitive to the change in rates. And so you'll see fewer sellers, you'll see fewer buyers, you'll see this drop dramatically again. The takeaway here with the new listings is sellers each week have been very restrictive. They are settling into understanding 7% rates. So that indicates, and you can see the red line is starting to trade a little bit above last year, a few more sellers each week, which implies more sales to happen in the first quarter. When we look at the other component that I like to keep an eye on, so as inventory rises, and this fall is inventory rising, a legitimate question is that a bad thing? Is it the market going to tank from here? Is that showing a flood of sellers? These are all the things we want to keep an eye on. Is the economy slowing such that suddenly we're going to have sellers flooding the market, which means too many sellers, which could mean prices come down? That's a legitimate question to ask as inventory is rising. What we see here is the height of each bar here. This is the new listings each week. And the taller the bar, the more sellers there are. And you can see 3 years of cycle here. And this year, there were fewer sellers all year long. The light portion of the bar are the immediate sales. So these are the ones that are taking offers and going into contract essentially immediately after listing. And what that means is during the pandemic, these are the bidding wars, and these were like, oh, I listed it on Thursday and I got a contract on Friday and we're closing, in 8 days. That was that phenomenon during the pandemic. This year, much fewer of those. And last fall, you can see the light portion of the bar shrinks really dramatically as that market cooled. It stopped July 4th week last year, and then the market shrank all year long. You can see that right in the middle of the chart. There's that dramatic step down as the market adjusted to higher mortgage rates. So what we're seeing right now is I've drawn the dotted lines. So you can see we have slightly more listings than last year, and we have slightly more immediate sales. So that says to me that there is buyer demand that is ready to take up the incremental supply. That means we are in a supply constrained market. And one of the reasons we've had record few or very few sales this year is because we've had very few sellers. So next year, as we get slightly more sellers, that implies that next year transaction volume is likely going to climb as we have more sellers and more, and therefore more sales able to happen. So just starting to get more inventory and more new sellers and more more transactions, more immediate sales happening each week now. It's the holidays, so there's a little bit of noise in there. Like it's like the lowest part of each year, but it's definitely it's a notable trend. When we look at inventory across the country, so inventory across the country is up 2% more than last year at this time, but it's not true in all the markets. So what I did is made the map here. The darker the state, the greater the inventory change. So some states like Louisiana has like 50% more inventory now than last year at this time. Places like Austin, Texas do. So, and you can see the dark are sort of the south central states there. That's where inventory is building. On the other hand, in the West and in the sort of central Northeast, a big chunk of the country, inventory is still is down. It was flat year over year or down, and still at pandemic lows. And I'll show you a couple of states where we're still at pandemic lows of available inventory. Las Vegas, interestingly, has the lowest inventory compared to a year ago right now, and I think that's because Las Vegas is a volatile market. On the way up, it screams, and then when the brakes hit last year, inventory built dramatically last year. Then when we recovered this year, Las Vegas recovered very quickly this year. And so inventory got gobbled up again. Las Vegas is both affordable. It's next to California. It's got a few of those immigration things. It's got a ton of investors, so it's more volatile than most. Phoenix is also much more volatile, but Vegas was the most this year. And so what's happened right now is the least inventory gain is the most inventory shrinkage year over year is actually in Las Vegas right now, but also in the Northeast, where some of the Texas markets, Austin in particular, the Florida markets, our inventory is rising. And therefore, let's look at how we will project inventory for 2024. We have this key, the dotted line is the forecast of the inventory curve. Each line here is a curve for the year, and the dotted line is the forecast for the year. We're going to start, as I said, with a slightly more inventory than last year. And it was assuming this forecast is done before mortgage rates dropped huge the last couple of days. And it assumes that we're staying in rates around 7%. If rates are climb above 8, that's going to show inventory climb. It'll adjust this forecast up during the year. If rates drop into the 6s and lower, you're going to watch that inventory get gobbled up, and that whole line is going to shift down like it did this year. We expected that the dark red line is a 2023 line, and I expected that to be shifted up the whole year as well. But the beginning of the year had mortgage rates fall during the buying season, inventory got gobbled up, and so inventory fell very quickly. So this, as we look right now, this is how we're seeing. It also assumes that we probably have slowing economy this year. Finally, we expected that to happen a year ago or more. It did not happen, and the economy is still really roaring. Soft landing, but so finally, assuming that you have some economy softening, that would imply that you'd have more inventory available than last year in the next few years. As we keep higher mortgage rates for multiple years, I would anticipate we get a little build of inventory in multiple years, and it will take us multiple years to get back to the old normal, those lines, 2018, 2019 at the top of the chart, where we had 800,000, 900,000, 1 million homes on the market, and finally move past that, like multiple years. It took a decade to get down to the pandemic lows, and you can imagine us taking a long time to get back to the peak. There is nothing in the data now, and people ask me this question: is there a scenario where lower rates means a lot of sellers are going to flood the market and go, "Oh, I can get out"? There's nothing in the data now that shows a flood of sellers anywhere in the data. Not by investors, not by Airbnb owners, not by people out of work. Nobody's out of work. So, like, none of that is anywhere in the data at this moment. So, I don't see a scenario where falling rates leads to a flood of sellers and more inventory. I expect it to follow the same pattern. Falling rates means falling inventory over the next year. So, what does that mean for your buyers and sellers? Well, they say, I'm going to wait to see next year if rates are cheaper, then I'll go shopping for a home. And that might be the right strategy for affordability standpoint. But they should know that if you're waiting for lower rates, a lot of people are waiting for lower rates, and that's going to mean tighter competition and less selection. That may be the right strategy for you because you want to wait for lower payments. On the other hand, if you can, if you can uh, find the place you love now at a price you can afford now, maybe the strategy is to go now before the competition comes in there because everybody is thinking the same way for you. And again, um, there's no signal in the data that there's going to be suddenly a lot of inventory. So keep that in mind when working with folks who are on the fence right now. All right, let's switch over to the contracts pending. What we're doing is we track every home for sale in the country and all those going into contract every week. What we can see here, the height of the bar, the total number of homes in contract. During the pandemic, there were more homes in contract than active for sale on the market. It was nuts. Inventory's built a little bit and the sales rate fell. So that's back to normal now. But what we can see is, most of the year we had dramatically fewer homes in contract than the year prior. And obviously, if you're in the business, like that there are dramatically fewer home sales this year, dramatically fewer mortgages this year than there were the year prior. And what we're seeing right now is the light portion of the bar here. Each bar is a week, right? And the total number of homes in contract, the pendings, the taller the bar, the more home sales that are going to happen. The light portion of the bar are the new contracts each week. And so while there's still just barely fewer homes in contract, the total bar is still a little shorter than last year. 279,000 this week versus 282,000 a year ago. The light portion is starting to grow. And so there were more new sales pending this week than last year at this time. So this is another indicator of home sales for 2024 look to me like they are expansionary. We have more sales in 2024 than we did in 2023. It looks to me like the worst of the housing recession, the recession being the number of sales, like the total sales volume, went from 6 million to 4 million or under 4 million. 30% fewer sales is a big deal. But it looks like we're past that. And now we will start to see climbing and have more sales in 2024. I don't see, this is early in this signal, but we can see the signals in a bunch of places. Here's another way to look at it. So this is each line is a year here, last year and this year. The dark line is this year. And you can see these are new contracts each week. And each week, all year long, we were running like 30% fewer sales, like and just way fewer, 80,000 new contracts in a given week versus 60,000. Like it's a big difference. And this is single family homes. Then we can see the lines converged. And they've converged at the end of the year here. And the dark red line is now starting to be above the last year, the light red line. So this is showing us that each week there are slightly more sales than there were in November and December last year. We're slightly moving ahead. And so again, this is where it feels like that the sales rate has reached its bottom. It's starting to get ahead of last year. And starting therefore 2024, we'll have sales growth. If rates dropped big, if they in the last 2 days, but also last few weeks, and if they stay there, stay in the sixes, go lower towards six or even in the fives, then I think you're going to see the contracts pending climb significantly, and will be you'll feel it all the way across the market. But that's the competition for those buyers too, right? We'll see it. We'll see it immediately, and we're already seeing. And really, this is an illustration of the rule of thumb I mentioned, which is consumers are more sensitive to changes in rates than to the absolute levels of rates. Um, the and so if even if rates stay at seven or in the sevens all year, you're going to see sales climb and that's what we've been seeing here is a slight increase. And there were 6% more sales this week than the same week last year. And then this is one more way to look at that sales growth, like how we've shifted over to sales growth. And you look at the change in pendings from the prior year. So we started the year with 40% fewer sales. Now each week at the right end of the chart here, we are growing. We have 6% more sales than last year, 4, 5, 6% more. Each week is starting to be expansionary. And so it really looks like we are finally above the sales rate, finally turning the corner. Let's do days on market. We'll do prices, and then we will do some local stuff. Days on market, currently just under 2 months for typical sales. It's a little bit longer than last year. You can see how the climb last year was climbing much more dramatically because the consumers are sensitive to changes in rates, and rates went from ultra low to they jumped 450 basis points in the year, and so days on market climbed. This year it's been climbing steadily. So rates are higher. Consumers are sensitive to that, but the change wasn't as much as last year. So we can see that in the days on market. We're going to come back down, not get as low as we did this year. So not as I don't see it getting that competitive on there because it still have affordability challenges. But I don't know. We have, if they're sensitive to that changes and rates climb down significantly, you could watch the market time accelerate as well. Okay, let's talk about pricing. Median price for single family homes in the US is $425,000 right now. Home prices are up 2 to 3% over 2022. That's nationally. Some markets are up, some markets are down a little bit. Actually, there's only a handful of markets that are down. If you own condos in downtown San Francisco, those prices are down, and they have not found a bottom as far as I can tell. If you are buying in Austin, home prices in Austin are down from the super bubble pandemic peak, and does not appear to have found a bottom yet. But only a handful of markets like that is the case. Most of the country is about flat year over year. And actually now looking at flat, we're looking at 2 years of flat home prices. And some places, home prices are up. So 2 to 3% gains over last year. And we've been in that range for a while. We're going to finish the year in that range. That's the dark line here. When we look at the median price of the new listings are the cohort of properties that get listed for sale in a given week. And it's a really powerful leading indicator of the market as a whole. And that's because the sellers and listing agents, they are using all the data, the experience around them. They know how many bidders were on the house down the street. They know how many people are in the open house. They know how many buyers are in the hopper and touring. And so when you go to list a new house for sale, you price it a little more aggressively or at a little discount based on all those things that you know. And so when the market is cooling, the price of the new listings ticks down faster. When the market is hot, like in January of 22, almost 2 years ago now, you could see that bright red line spike really dramatically. Those were people getting the last of the cheap rates. They knew it was coming to an end. People were bidding wars. You could see it dramatically sharp there. What we can see right now with the price of the new listings is each week we're pricing higher than last year, 2, 3, 4, 5% higher than last year. And that implies that future sales are going to close at prices higher than last year. So what we can see into the new year is the leading indicators for home prices are flat to up. There's nothing in the data here that shows, price growth, right? Like there's nothing that looks like 22 where, we could see home prices climbing, 5, 10% in a year. Nothing in the data yet. We still have affordability challenges. So it's unlikely that there's going to be a big price increase here, but there's also nothing in the data that shows prices declining. And there are definitely home buyers on the fence waiting for home prices to crash. Uh, and really the question is, how long are you going to wait? There is nothing in the data that shows that, unless you're buying condos in downtown San Francisco, or maybe, buying houses in Austin. There might be some signals there. A couple of places, Louisiana or Memphis, where it looks like home prices have been weak this year. But even in those places, I anticipate that those are likely going to moderate for this year. They haven't really found the bottom, but so for most of the country, there are plenty of home buyers sitting on the fence who are saying, like, I'm just going to wait till it tanks, and then they are expecting rates to tank and home prices to tank and finally have selection. And like it looks like, if we get lucky and rates fall, they'll get that benefit, but the others seem really unlikely to happen. When we look at the price of the new listings year over year, you can see the dark line. Each line here is a year, and you can see where the dark line was below last year by a few percent much of the year. And then in the fall, now we are trading above. So again, this is a leading indicator. It shows price strength going into next year. Not a lot, a little bit, but prices are holding up better than last year. And when we look at the pendings, so we know that the active market prices are up, the new listings are up, the pendings home sales prices are up as well. The total pendings, the bright red line here, these are all the homes that are in contract now. That is at $375,000. That's a 4% increase over last year at this time. And the newly pendings, the ones going into contract each week, is 3 to 5% over last year at this time as well. So the dark red line you can see will dip for the holidays and then start back up as we start the January sales process again. And so we will, things that go into contract over New Year's or Christmas, New Year's week there's stuff trades at a discount there. But then we'll see it start to recover for after the first of the new year. And there's a bunch of these that are leading indicators for future sales prices that I really like to watch in January, like between the second and third week of January. How steep is that jump? Are there people bidding? Are there multiple people bidding, on homes that they've been kind of looking in the fall, and suddenly rates are at 6.6, and so they bid, in January, the first week of January, and we watch home prices climb there. It'll be really fascinating. It's going to be a lot of fun to watch those after the new, right after the new year. The price curves, the price of the new listings, and the price of the new pendings are going to be fun to watch there. All right, let's shift to price reductions and this leading indicator, and then we're going to shift into the local data. So if you watch our work here at Altos, you know that we love the percentage of homes on the market with price reductions is a leading indicator for where sales will happen in the future. If a house is on the market now and it doesn't have any offers, does a price cut in December and it gets an offer in January, and then it closes in February, and then you start hearing about that in, say, March. But we can see right now who needs to take a price cut and who's taking price cuts. And there is a normal range 4 price cuts. About a third of the market take a price cut before they sell. So there's that gray band in the middle. Each line here is a year, and you have more price cuts in the fall. And then you get fresh inventory in the spring, and so fresh inventory and most buyers, so the price reductions decline. And then midsummer, you say, oh, it hasn't sold yet. We start cutting price by the holidays. You're like, oh, let's cut price, and then the market resets for the new year. So we're at the point where we're sort of at peak home price cuts right now in November. And a couple of things we know. One is that rates rose a lot this fall, and price reductions rose this fall. You can see that in the dark red line there, there's a September inflection point where it starts climbing again. Last year too, rates rose last year in September. So both years we could see price cuts climbing late into the year. We went this year from being basically right above the normal range to significantly above the normal range. So this fall, we could really see people waiting. We know that home sales were down in October. And so we're currently at 38.3% of the market has had a price cut. That's, that is reflective of higher rates and the affordability challenges we have. But we also say that we're past that, and we're likely to start seeing that do a nice sharp decline. Last year, the bright red line, became the dark red line. So the dark red line at the beginning, January of this year, started with higher price cuts, but because rates were falling, they came down to that normal range, and that put a floor. We could see that putting a floor on home prices, which last year at this time we could see home prices are down. We could see year-over-year declines, and so as soon as consumers jumped in, they put the floor on prices, and so suddenly we finished 2023 with home price increases, which was very unexpected to me. I did not have that call. I expected us to be flat to down for this year. I expect us to be flat, like same range, like plus or minus. Like I said, there's nothing in the data that indicates a big year unless we have dramatically falling rates, or the other way would be if we have, economy tanks hard or rates jump over 8%, then you can, those are the scenarios where we'd see climbing price cuts, and then we'd see declining home prices. So that's where we're dialing in and expecting a flat year for home prices in 2024. And we're at 2 to 3% home price gains. You could basically call that flat for this year. After inflation, home prices are basically unchanged for this year, plus or minus. It's basically noise in the data. Okay, let us switch to some local data and dive in. I like to start with looking at the Altos product. What I have here is I have the advanced analytics page up. In my account, we have reports for all of the country. In your account, you'll have your local markets, but you get to see who's opening your reports each week. We send the contacts. Those are the people we are sending emails to for you. And so these are your buyers and your sellers, and they're saying, "Wow, I think the market's going to tank this year, but when it does, I'm gonna pounce." So even those folks, or even the folks who are like, "I need to wait for more affordability," what you want to do is you want to say, "Let's get the report into your inbox every Monday. I want you to watch this one number. We can watch inventory climb. We can watch price reductions. If those price reductions are kicking up, those are your opportunities. On the other hand, if they're kicking down, that means your competition is heating up. So you should know that." So we're going to put this Home Sound report into your inbox every Monday, and it's branded for you so that your buyers and sellers are dealing with you. So that's what you want to do with your Altos reports. I have the advanced analytics page up where I like to look at things over time. So let's look at the price reduction. We're just talking about price reductions. I have a rank of the cities with the most price reductions around the country. And this little spark line shows us 3 years of trend. Indianapolis happens to be the peak with the most price reductions around the country right now. And it's interesting because Indianapolis is like there's a couple of Ohio markets, but that for Midwest is one of the higher is one of the only places in the Midwest. Most of the high price reduction markets are in Florida, Texas, here's Colorado. These were ones that were very boomy. They hit the brakes last year really hard and then recovered a bit this spring and then hit the brakes when rates rose again this spring. What we can do is look at Austin. So Austin for a few months has been the top price reductions. And so, as I mentioned, Austin is one of those markets that probably hasn't yet found a bottom in home prices, but I think this year will. I don't see indication of dramatic. And the reason I don't is last year at this time, we could see 62% of the homes on the market in Austin had a price cut. That said, the homes that sell in the future were going to be at lower prices. This year, 51%, 53 down to 51% right now. So fewer price reductions than last year at this time. So the signals are less bearish for Austin than they were last year. And so we are likely to see a bit more of a floor on home prices in Austin this year. The Florida markets have in the last few months been dominating the price reductions. And Florida is on a slightly different seasonal scale than much of the country. They do a lot of purchasing in the winter, so Florida is on a little different sale. I'm going to show you in a minute. I'm going to dive into Denver and what we can see for Denver. Denver was one of those markets that was really boomy. You know, if 30 to 35% price reductions is normal, in February of last year, 18 months ago, only 11% needed to take a price cut. That's because there were multiple bidders. There were people knowing they were getting the last of the cheap mortgage rates. All of those things were happening. And then Denver went from 11% to 60% with price cuts last year, and then recovered very quickly this spring with cheaper mortgage rates. Slowed this fall, but not as dramatically. So much of the country, the big moves were last fall. The prices down were last fall. And so then we reported year-over-year price decreases were June of this year, first, second quarter. And now we are looking at price increases because like home value is climbing, and you can see it because the demand is there just enough to meet the current supply. As I'm looking at inventory building for 2024, I like a chart like this for Dallas, which I've built. What I've done here is compared inventory this year versus pre-pandemic. So the pandemic ones are everything's nuts, but pre-pandemic is 17, 18, 19. And you can see normal levels of inventory for Dallas in 16,000 to 20,000 homes on the market in the Dallas metro. This year, we were still at 13,000, like 40% fewer. All year, we've been getting closer to normal for Dallas. And I can see as if rates stay in that 7% range, then we get back into a normal cycle for cities like Dallas Dallas has higher property taxes. So the holding costs in Dallas are higher. So you get more resale than you do in, for example, California, where your property taxes are forever low. And so California has chronic shortage, but Dallas will get back into its healthy cycle. So it looks to me like we'll start. Those are signals that say we have more sellers that are going to happen, more sales in 2024. There's a bunch of those signals that look like that the peak of the challenge is behind us. In Dallas, when there's only 9,000 homes on the market, you can't do 20,000 sales because there's only 9,000 homes on the market. And that was still this year. We're going to start the year with more homes in Dallas, and that's going to lead to more sales. We can look at I have a bunch of charts open. Let's look at inventory across the country. I did this in the map. We can see Texas has more homes than last year at this time. Florida is up. California has fewer homes on the market than last year at this time. a really dramatically difference in how and Arizona as well. So Arizona had big inventory climbs last year, but inventory in Arizona is down year over year. All right, let's do some local markets to wrap it up. So I mentioned Denver. This is an Altos report. This is for the metro of Denver. But what I wanted to do is look at inventory over time in Denver. So I've got 5 years of inventory here. You can see the seasonal change. You can see normally you'd be inventory peaks in July and is way down by now. This year, inventory peaked in October in Denver because we had rising rates in September and October that caused rising inventory at that time. We're now past the curve. I think we're going to see, like I mentioned for Dallas, you can imagine that Denver is going to start the year with more inventory than last year. And so slightly more inventory means slightly more sales, and slightly better selection for buyers, unless rates drop, and then that gets eaten up really quickly, and then we could follow ourselves back down into that lower cycle. I like to use, when I look at the Altos reports, the price range segments at the bottom. The high end of the market may be behaving very differently from the low end. And when you're working like in a zip code with your clients, they may say, hey, that house down the street, I've seen it's taken 4 price cuts and it's not selling. But we go, yes, but that's a different price range than you are shopping. So in Denver, in the Denver metro, $1.5 million is a high end and is significantly slower than the under 500,000 range, or really anything under 800,000 in Denver is where the attention is. And so being able to show your buyers and sellers, like, this is the price range we want to pay attention to, that becomes very powerful. I have Massachusetts open because Massachusetts is the state with the fastest market time right now. I mentioned it's also the fastest, the lowest inventory. So this is inventory over the last few years in all of Massachusetts, obviously dominated by the Boston area. But what you can see is here's pandemic lows, and we are still in pandemic lows of inventory available in Boston. And this is true for much of the central and northeast. And the implication here is, when we're thinking broadly about the potential, homes are very expensive. Payments are very expensive. And so it is natural to assume, especially for casual observers of the housing market, to assume that home prices must come down because the homes are expensive and they're unaffordable. And what the observation is that there is supply and demand side of that equation. And so they would be assuming things are unaffordable, so demand is weaker. If supply were to jump and demand were to fall, now you have a recipe for home prices to come significantly down. What the key here is that we don't have any signal of supply really jumping pretty much anywhere in the country. And especially in places like Massachusetts, inventory is still basically at record lows. And so broadly, there's no signal of supply and demand getting out of balance. There's just no supply. And so that is really what we want to look at here. We can look at Massachusetts overall. We can see, days on market climbing for the fall, but we can see here's our price reductions for Massachusetts, only 36%, so right in the normal range. We can see that the last few months, prices decline for the fall, and then they will start their new year climbing again. Let's look at Miami. So Florida markets have had a lot of attention this year. Were some of the slowest markets. Miami can sometimes be in its own orbit. Miami is much more close to balanced in the terms of buyers sellers than much of the country. And that means even if inventory is high, demand is lower. Inventory is if supply is low, demand is also low, and it brings it much closer into a balanced market. We haven't really seen buyers market conditions in this country in over a decade, so it's really balanced in that case. We can see that inventory. So I have the inventory chart here up for Miami. We can see that, not long ago, 20,000 homes on the market. In the pandemic, there were less than 5,000 homes on the market. And now we're at 11,000. So inventory's up year over year. It will start the year higher. We can imagine a little bit of expansion there, and therefore a little bit of more transactions. In the price ranges in Miami, high-end Miami is very different from low-end Miami. And you can see, 100 days versus 42 days. You can see exactly where the demand is in the Miami market there. Again, if I don't have time to get to your market, I can only go a handful here. I just picked out some that I thought would be interesting. Go book time with our team. We can talk about how you set up for your local market and how you communicate with your buyers and sellers. There'll be a link in the chat to go do that, and just go get time with our team to go set things up for your local market. In Portland. So Portland is, I pulled up Portland because I wanted to track the price decreases. Over time, you can see the normal range for Portland is right here in the normal range. 30 to 40% of the homes take a price cut before they sell. Last year, dramatically more price cuts. Like, you could see exactly where the market slowed. This year it recovered quickly. And then here it is in September, mortgage rates ticked up, it started climbing, and price reductions started climbing as well. You can see exactly and immediately how quickly people adjust to those higher rates this fall. And so pricing in Portland there's nothing strong there, right? It's still 40%, but it is not climbing, and it's less than last year. So Portland really has a view, much like the whole country. We can see why we don't expect home prices to drop negative this year. And you can see an even more dramatic price range segment in Portland. The high end at 1.3 million, taking 120 days versus 40 days, things moving pretty quickly at the low end, the entry level in Portland. And then finally, I mentioned Vegas, as Vegas has the biggest year over year change in inventory down from last year in the country. You could see that Vegas went from normally having 7,000 or 8,000 homes on the market in the pandemic, 3,000 last year, right back to normal. And then, wow, this year that got gobbled up and is still significantly fewer, and basically back into the almost pandemic lows of available inventory. If I zoom in and just look at this year, you can see how much different the market is from last year at this time, 7,000 homes versus 4,100. That's a big change. And that's why Nevada, the state of Nevada, had our significant drop of when I looked at that map earlier. And you can see the price ranges in Vegas as well. I've had a lot of questions recently about, like, aren't the people buying at $1 million or multiple millions? Aren't they cash buyers? They may be cash buyers, but they are still interest rate sensitive. And so we don't see places where the expensive stuff is moving quickly. You can see a dramatic change here. The most affordable parts, the entry level costs, are the ones that are moving most quickly. So again, when you're communicating with buyers and sellers, it's like, yes, I know you think the market's slower, but in your price range, things are moving because that's where the demand is. And let me show you that what's happening. And let me show you this row here. And by the way, I can show you exactly what you're going to get for 400 grand in Vegas. It's a 1,500 square foot house that was on a small lot that was built 25 years ago. We know exactly what it is. We do know that if you're an investor, you can add space to the house. You could remodel and increase that house on the same lot, but you're not going to make $1 million house because those are bigger lots. So you can have that conversation in this data, any zip code in the country. Okay, that's the local data. And let me just wrap up by saying, like, I don't have time to talk about the every local market, but at Altos, we track every local market in the country, every zip code in the country. And if you're not putting the data in your client's inbox right now, you got to set up for the spring buying season right now. They need to know exactly what's happening. You can put that in the inbox and say, mortgage rates are moving. The market is going to start moving very quickly too. So keep your eye here and watch these numbers so that we can take action while you're in the market. You can get the scripts and get the ebook by clicking through there. That'll be a link in the chat that you can go click through and download that ebook so you can talk about the data the way I do. And let's get started today. So go get the data. We can get you up and running immediately, get it into your clients' hands, because like January could be hot. Like, man, if rates stay down there, could be a significant difference. All right, everybody, I'll stick around in the chat for a few minutes to make sure we got all the questions answered. Lael and Jessica have been in the chat the whole meeting. Thank you so much. I appreciate your time, and we'll talk again soon.